everyone, and welcome to the April 2025 edition of MoneyLetter on Markets. I'm Brian Kelly, publisher of the MoneyLetter. Thanks for joining me. With the markets amid severe volatility as we record this due to tariff uncertainty, I thought I'd start with this month's blog. It's timely and it's called, "You Shouldn't Be Surprised by This Market Correction." Of course, we can officially change the title from correction to bear market after the last few days trading. This article can also be found on the blog page of our website, MoneyLetter.com. You should check out that page periodically for investing and financial planning tips. Here it is. A stock market correction is usually defined as a decline of 10% or more from a recent peak in major indices like the S&P 500. By comparison, a bear market is marked by a decline of 20% or more. Over the years, declines like these have occurred with regularity, rectifying soaring valuations and tempering speculative excesses. On March 13, 2025, the S&P 500 entered into its first correction since 2023. It officially hit bear market status on April 7th. How often and how much, we ask? Since the 1950s, the S&P 500 has gone through approximately 38 corrections, an average of one every 1.84 years. Let's round it off to a correction roughly once every 2 years. That's one of the reasons we've been saying you shouldn't be surprised we're going through one now. An average decline during corrections has been around 14%, though individual corrections can vary in intensity. Here are some of the noteworthy bear markets and corrections since the 1960s. In 1966, the S&P 500 declined by approximately 22% due to an economic slowdown and tightening of monetary policy. In 1973 to 74, a significant bear market occurred, with the index dropping about 48%. This was influenced by the oil embargo and rising inflation. In 1987, we went through what's known as Black Monday. The market plummeted over 20% in one day, marking one of the most rapid corrections in history. 2000 to 2002, we had the bursting of the dot-com bubble, which led to a 37% decline in the S&P 500 over 2 years. In 2007 to 2009, everybody will remember the great global financial crisis, which resulted in a 57% drop in the market, making it one of the most severe bear markets since the Great Depression. And more recently, in 2020, the onset of COVID-19, the pandemic caused a swift 34% decline. This was followed by an equally rapid recovery. After 2 years of extraordinary stock market returns, 20% plus for the S&P 500 in both 2023 and 2024, we felt the markets were overdue for a correction. Several factors contributed to our anticipation of a significant pullback. One, we had an extended bull market. Prolonged periods of market gains can lead to overvaluations, increasing the likelihood of a corrective phase. Reason number two we thought we might have a pullback was certain economic indicators. Signs of economic slowing often precede market corrections. At this time, we do not see a recession in the cards, but there have been some recent soft economic reports. And reason number three is geopolitical tensions. Global events such as trade disputes, boy, we sure have one now, or political instability can trigger market volatility. The recent trade uncertainty as a result of U.S. tariff policy certainly has been a catalyst for the recent market declines. What are the implications for investors? While corrections in bear markets can be unsettling, they are a natural part of market cycles. Historically, the S&P 500 has gained an average of more than 8% 1 month after market corrections hit bottom, and more than 24% 1 year later. This type of market resilience underscores the importance of maintaining a long-term investment perspective and not making impulsive decisions based on short-term market movements. Of course, it remains to be seen if the U.S. economy falls into a recession as a result of this potential trade war. As we record this, we don't believe it will. Fiscal and monetary stimulus are within view, and trade policy is negotiable. However, it doesn't take away from the short-term pain and nervousness that investors are currently enduring. Next, let's take a look at our featured fund for the month of April. And that fund is iShares Europe ETF. The ticker is IEV. And in our MoneyLetter newsletter, that's in our international section in the Europe category. In returns that are calculated through April 4th, on a year-to-date return, the fund is up 2.8%. And over the 5-year annualized period, it's up 12.8% per year. This fund holds some big names that you probably have heard of. SAP is its biggest holding. Nestle is its second biggest holding at 2.4%. And then it holds ASML, Roche Holding, and AstraZeneca. So you've heard of some of those names. The iShares Europe ETF seeks to track the investment results of an index composed of European equities. This fund provides convenient access to a broad range of European companies. The top 5 countries as of year-end 2024 were the UK, 24% of the portfolio, France at almost 17%, Switzerland at just about 15%, Germany 14%, and the Netherlands at 7%. We recently added this fund to the MoneyLetter Plus Select ETF model portfolio as we see the opportunity of more attractive valuations in the Eurozone and other European countries compared to the US. Our next item on the podcast is world markets. Since we were just talking about Europe, we can give you an idea of how the markets stacked up in the first quarter. We regularly track 7 indices. And since we moved into March and the markets are moving quite a bit, we moved into April and the markets are moving quite a bit, we'll just give you the ranking of the countries over the first quarter. Of those 7, Brazil was the best returning market. Second was Europe, which is marked by the Euro Stoxx 50 index. Third was Mexico, the Bolsa IPC. Fourth was China, the Shanghai Composite. 5th out of 7 was India, the S&P BSE Sensex. And then at 6 was the United States, the S&P 500. The S&P 500 dropped 4.6% in the first quarter. And last but not least was Japan, the Nikkei 225, and that was minus 10.7% in the first quarter. For more information on our world markets, you can see the April issue of MoneyLetter. The next item, we'll talk about what you might want to consider doing with your cash reserves. With the stock markets declining in value as we record this podcast, now is a good time to review the returns on your cash and other low-risk holdings. With the likelihood of several Fed cuts later this year, you might consider locking in today's relatively high rates with a certificate of deposit or a CD. If you don't want to lock in your funds, there are high-yielding money market accounts that are paying several points more than a simple bank savings account. For example, T. Rowe Price Cash Reserves Fund reported a 7-day yield of 4.18% in the April issue of MoneyLetter. Call us, and representatives at our sister company Asset Strategy Advisors can point out to you even more solutions that make sense for your cash balances. In a related topic, here's one of the 5 pillars of financial wellness. Did you know that establishing an emergency savings account, or ESA, is the first pillar of financial wellness? This pillar is about creating a financial safety net to keep you from experiencing money-related hardship due to unforeseen circumstances. An emergency fund is essentially a high-yielding, liquid, cash reserve account that is separate from your savings or checking account. It is designed for unexpected expenses such as medical emergencies, car troubles, sudden job loss, or urgent home repairs. Think of an emergency savings account as your what-if money. Here's a key benefit. By having an ESA, individuals are less likely to dip into their long-term savings, such as retirement accounts or investment portfolios. We recommend having 3 to 6 months of essential expenses in a safe, separate liquid account. 3 months is the recommended minimum, and 6 months is the long-term goal. Finally, if you're not currently a subscriber, you can start a MoneyLetter subscription by visiting MoneyLetter.com, click subscribe, or by calling toll-free 800-890-9670. That's MoneyLetter.com, click subscribe, or call 800-890-9670. If you're a first-time subscriber, we have a half-price offer that will allow you to try MoneyLetter for a full year for only $64.50. Call us for more details. That's it for the April edition of MoneyLetter on Markets. Remember, if you have any ideas for this feature, contact us by email at service@moneyletter.com. We appreciate you listening to our podcast and look forward to getting together again with you next month.